we're going to be talking about life insurance. Is it needed for a mortgage? Why are life insurance policies cheaper online? And what are the benefits of going through a broker to get life insurance? Hello, welcome back to our channel and podcast. My name is Gemma, and here at WOS we talk about all things relating to money, mortgages and positive money mindset. So if that interests you, then be sure to subscribe to our channel and hit the thumbs up. It really helps with our YouTube algorithm and means that you won't miss out on any of our videos. On today's episode of Let's Talk Money and Mortgages, we have Abdul here with us. Abdul is our WOS insurance manager who is going to be discussing with us all things insurance. Hi Abdul, how are you doing today?
I'm doing great, Gemma. Good to finally be back.
Welcome back to the show. Today's video is all about life insurance, so let's get into it. So the first question that I have is, what is life insurance?
So life insurance is an insurance policy that pays out on death. It's as simple as it is. It covers for one particular thing, and that's death. So in terms of other insurance policies, life insurance is as easy as it gets.
Okay, so then why should someone have life insurance? What are the pluses?
So there's quite a few reasons. With life insurance, essentially it's not for you, it's for your family or the people you leave behind. And that's quite a nice way of putting it, because when you think about life insurance, it's usually there to protect a particular interest in your life. One of the key reasons for having life insurance, or one of the reasons that life insurance is usually taken out, is after someone goes for a mortgage, for example. That sort of gives you an idea of why the policy exists, is because of a particular need. With the mortgage side, what the life insurance policy can do for a family, it could essentially pay out your mortgage in the event of your death so that your family isn't burdened with having to make the repayments. It can be used just to protect the family if the main breadwinner has passed away. Quite a few things, but it's mainly for the people that you leave behind.
Yeah, so that's the main reason that a life insurance policy is important for a mortgage, right?
Yeah, and with the mortgage, the one main thing to keep in mind is that life insurance for a mortgage isn't compulsory, but it is extremely advisable. And the reason I say that is because, for example, if there were two people on the mortgage application, in the event of one of the applicants passing away, the entire mortgage burden is leveled on the second applicant. Now, this is where having a life insurance plan for both of you would be beneficial. The policy essentially pays out the lump sum in the event of the death. What that allows the family to do is settle the mortgage. And it's beneficial because the last thing that you'd want to be stuck with is having to deal with a death in the family and then having to deal with financial difficulties. And I'm pretty sure that you wouldn't want your family to be dealing with it either.
Yeah, there's so many things. I don't know if any of the viewers have had somebody pass away, but I know from experience that when someone does pass away, there's a lot of stuff to sort out, and it's not a simple process. So I guess it's one less thing to worry about, because the last thing you want to do, especially if you weren't the main breadwinner, is to suddenly think, oh gosh, I've now got to go back to work, find a job, pay the mortgage. Like, how am I going to pay this? If it can all be paid off on the event of death, then it just makes things a whole lot easier, doesn't it? It gives you that kind of room to breathe.
Exactly.
Not worry.
And it's not an easy conversation to have by any means, but it is something that we really need to get to, especially in the time that we live in with the pandemic and the absolute uncertainty that's going about. It's something that everyone needs to reevaluate. It's something that a lot of people I know have been putting off for the longest of times. And I know it's maybe harsh to say, but before you know it, it may be too late. Because with life insurance, two of the factors that a lot of people who put it off don't keep in mind is that with life insurance plans, your age is heavily linked to how much you pay. That's one factor.
Okay.
The second part is any medical issues, any pre-existing conditions. So you may say that, I don't think I may need cover right now. I'll think about it in 5 years. Once the pandemic's over, I'll probably be better off then. But in 5 years' time, there's two things. You're 5 years older, first off. And the second part is, you can't really guarantee that you'll be in the same bill of health. You can't tell me, I'm pretty sure 5 years down the line, I'm not going to have a single thing to disclose. So I might as well just go for a policy then. So you're losing out on two fronts here.
Right, because with life insurance, is it the case that you take out a policy now and then it stays the same price for X amount of years, or does it go up? How does it work?
Right, so it's a yes and a no, because it's a different type of policy, right? There's essentially two different ways of looking at it. Now, the first one, like you mentioned, where you'd apply for a policy and then the plan, the amount of cover that you have and the amount that you pay over a month remain the same. Now, those are just the standard level term assurances. And those are the cheapest, simplest ways for you to protect your family. The second one is where the policy is linked to the retail price index. Now, the retail price index is essentially the Bank of England's inflation rate for the year. So the simplest way of putting it is it's making sure that your policy stays in line with inflation. So at the end of your policy term, you're getting the right value for your money. So that policy increases every year. So every year, your insurer will send you an acknowledgement saying, because you've opted into this particular option, this is how much your cover needs to increase, this is how much your premiums will increase. It's really useful if you think about 30 years down the line, if your policy has a 30-year term. In 30 years, the value of money that you have insured yourself for is definitely not going to be the same. So what the policy does is make sure that whoever your beneficiaries are, they get the right value. So that's a good thing off the bat, but it completely depends on, what you aim to achieve with the plan. Now, the third and the final simple life insurance plan, let's put it that way, is a mortgage protection plan. Now, a mortgage protection plan, the amount of cover you have keeps reducing year on year. So you start off, for example, let's say with £500,000, and every year the amount of cover you hold keeps reducing because it's supposed to be protecting the mortgage. The whole point of the policy is just to protect your liability there.
Right, because if you have a capital repayment mortgage, as the years go on, you've paid off more, so
yes, that's a very
right?
good point actually, Gemma, because if you have an interest-only mortgage, it's not going to work, right? Because the debt that you have is going to remain the same throughout. So if you have a capital repayment mortgage, this policy might work because being a mortgage protection plan and the debt reducing constantly, insurers generally give you sort of an incentive to go for that particular plan. And there is a bit of confusion with this particular product is because even though the amount of cover you have keeps reducing, the amount you pay will not. The amount you pay will remain the same.
Is that because initially it's a cheaper price to begin with?
Yeah. So the insurer basically gives you a cheaper premium. So for example, instead of having to pay for a level term, you can pay a tad bit cheaper if you come for a mortgage protection plan. And the reason being, going forward, it's less risk for the insurance company, and that's why it's a bit cheaper. So it's sort of like an affordable option to having cover, because having insurance when you have a mortgage is extremely important. So if you can't afford a standard plan, at least you've got an option here with the mortgage protection plans.
Yeah, that's a really good point. And this next question is something that I know we've discussed in the office between us. I think it's just a really good point to mention. So what is the difference between the quotes that you find online and the quotes that you get from an insurance broker? Because everyone always says to us, don't they, but I found a quote online and it's much cheaper and,
Yeah, I mean, to be fair, when you quote for something online, the biggest issue is you're not really sure what you're getting a product for. The insurance quote may come out saying, you can get one for £10 a month, which sounds brilliant, but is that really sufficient for your mortgage? Is it sufficient for your family's needs? Those are things that you're just playing with, you're not sure of. And that's the thing with life insurance. You have the review of your family's financial situation, you look at what's required, and then you set your cover. These are long-term plans. And unlike the discussion that we had about private medical insurance, which is annually renewable, this policy stays on for a very long time. When you go for a plan online, you may be able to see very affordable products, but the one thing that you're missing out when you speak to an advisor is when I would speak to a client, I'd have a thorough conversation about what their financial situation is, what's actually required, and what the best product is for them, not just to meet those needs, but just also affordability-wise. We're looking at a lot of factors. And I think in the same way as our mortgage team works, we don't charge anything from our clients. So it's basically just a free conversation and we're looking out for the best because, we've got access to all of these tools and research that we do from our end. You stand to win either way.
Yeah, definitely. Basically, we're saying that what you really need to consider is your circumstances when getting a quote, because I think a lot of people just think, I just need one for a mortgage, so I'll just do a quick one and find something. But actually what we're saying is if you actually speak to somebody and go through your situation and your needs and your wants, then we can find the most suitable product for you that way, right?
Yeah. It's so much simpler because I've come across these kinds of issues with a few of my clients before where an online quote seems like the easiest option, saves them a lot of time perhaps, but if you think about it, you wouldn't really put off something that's long term. I've seen quite a few clients come across saying that they have insurance. So here at WIS we do free reviews as well, and then once we have a look at the kind of product the client has, we immediately can see there are things that can be enhanced, there are things that can be changed for the betterment of the client, whether it's affordability, whether it's the right kind of product. Even in certain cases, they may be paying for too much cover, and that may be a conversation to have as well.
Yeah.
Because like I said initially, affordability is key here. And the reason being, for life insurance to work, you're supposed to be able to afford the product in the long run. It's not going to do you any good if you can afford having a lavish policy for about a year or two, because that's not really how the policy would work. A premium that you would see today has to be affordable towards the end of your plan as well. So 20 to 30 years down the line, you should be able to make those premium payments, or else you just stand to cancel a plan later on, which no one benefits from.
Yeah, and I know you mentioned that there's sort of three main types of insurance. Are they quite set in stone? Like if your circumstances change, like how easy is it then to change the policy?
So with level and increasing options, it's quite straightforward. The level plan is the foundation where both of those policies start. The increasing option is just a box that we tick. Because at the end of the day, when you have that option clicked in, basically the ball's in the client's court. That's where they would get to decide if they want that option on or if they wouldn't. So when you have the increasing option clicked in, what the insurer does, they'll send you an acknowledgement every year saying, because you've opted in, this is how your policy should increase. So they'd say the amount of cover increases so and so, and thereby the premiums that you pay would increase by this much. Now, if a client doesn't want any of those changes, for example, on a particular year, you'd say, I'm fine with where the policy is. I'd prefer it if you wouldn't change anything. All the client has to do at that point is call the insurer and tell them not to do it. So it's quite straightforward. It's just conveying to the insurer that you don't want any inflation adjustments done for that particular year.
Okay.
With decreasing plans though, it's not the same way because it's a completely different product. And like we discussed previously, where it's a lower premium to start with. So you can't really switch back to a level plan. Essentially, it's going to be a brand new plan that's sourced.
Okay. Just to sum everything up, do you have any top tips for anybody looking for life insurance?
Yeah, I think the first one, the key one would be get it early as possible. The older you get, the more expensive it becomes. So the earlier that you get it, you just stand a chance to fix a very cheap premium for the long run.
Yeah.
If you're already going for a policy, be honest about pre-existing conditions. The last thing that you would want is not be honest with an insurance application. You could stand the chance of not being offered any claims. So that's something that none of us want.
No.
And yeah, so I think...
And then that's kind of the worst case scenario, isn't it? To pay for all that time and then at the end of it to find out that you don't get the payout that you thought.
And the crazy part is, I've actually heard this. Clients tell me that, do I really have to tell them about this particular thing? Because instead of having to pay £20, I can pay £10. And yes, it may be cheaper for you, but at the end of the day, you might just not get anything. So is it really worth it? And I think one thing to add on is stop smoking. And the reason I say that is because insurers will genuinely almost double the amount that you pay every month just for being a smoker. It's just because of the added risk involved. So I think that's one thing to keep in mind. So keep the habit.
Right, so if there's a habit that you were going to give up, that would be your suggestion.
That would be one thing, yeah. So yeah, keep that in mind.
Okay, well thank you Abdul for that great advice. I just wanted to put a reminder out there that these points may or may not be applicable to everyone, so please do talk to an advisor if you're unsure whether they are suitable for you. If you don't have an insurance advisor, I will leave Abdul's contact details below, as we're always happy to help here at WIS. Thank you so much for joining us today, Abdul. Audience, we will be back next week with another episode of Let's Talk Money and Mortgages. Have a great day, stay safe, and we'll see you again soon.